we have guest inflation. Normally, we bring you one guest. Today, we are bringing you two. We have the great Adam Taggart of Thoughtful Money. He'll be on to discuss inflation, the broader macroeconomy, and all things financial education. And of course, we have the great Amy Nixon. She's a housing expert based in Texas, and she kind of cut her teeth on the Airbnb phenomenon and trying to connect that as an indicator, and got quite a following as a result. So we'll have her on shortly to discuss housing prospects, and then of course we have our highly anticipated um, inflation report, which comes out monthly. You get it as a premium subscriber. We give you a little sneak peek on the blog, but we should have some analysis of that coming up as well. We do appreciate you listening. If you haven't already, do give us a follow. And of course, follow Adam and Amy as well, which we'll get into in a second. Um, we're just waiting for a couple people to show. But in the meantime, let's begin with one of our guests of honor. Again, you're listening to Truflation Spaces. It is our pre-BLS CPI edition ahead of the BLS print tomorrow. And we're going to go ahead and begin with the housing outlook in the United States, which is all the rage. Are young people ever going to get a chance to own a home in this economy? Um, what makes a good real estate agent? How can you tell? What are the prospects of the housing market going forward with regard to the broader economy? And what can we learn from places like Texas, where Amy's based? And that was a long way to go to welcome Amy Nixon. Amy, thanks so much for coming back on. We really appreciate it.
Thanks. I'm glad to be here.
Yeah, yeah. So, give us your hot take. You're based in Texas, right? Um, let's do like a 30,000 foot look, and then we'll get granular. What's the housing market in your estimation? What's it looking like? Is it bleak? Are you hopeful?
It's different in different parts of the country right now, and a lot of that has to do with the fundamental piece about housing, which is supply and demand. And that's why you have these markets right now like Texas and Florida where supply is actually back. I think we're the highest level of supply we've got in Texas and in Dallas that we've had in like a decade. And Florida supply is also just ramped up really high. These are Sunbelt regions where there's been a lot of new construction and building. And so a lot of the sort of pandemic issue was you had a huge wave of demand coming from fiscal stimulus, coming from low rate stimulus, coming from migration stimulus. Those are all these big demand pieces. All of those have pulled back now. We don't have the money being handed out to everybody. We don't have the low rates of like 2.8% or whatever they were at the bottom. And we don't have as much migration as we had back during that time. And a lot of that has to do with remote work and the way that that started to shift back towards return to office. I know Amazon just made a big change with that. And I think a lot of other companies are going to follow suit. So um, those demand pieces have all weakened pretty considerably. And in the meantime, supply has been built up, and particularly in these Sunbelt regions, because these are regions where we actually have had a lot of construction. And we were trying to have a lot of construction even during the pandemic, but they were backlogged by supply shortages and labor shortages. Those have all been sorted out in the last 18 months to 2 years. We've had record numbers of supply coming online in terms of new builds. And so we're sort of seeing now the equilibrium of not enough housing units compared to the demand is shifting now towards we've got a little bit of a surplus of housing units available, and all of those demand pieces are weakening and continuing to weaken.
Yeah, and so that's kind of counterintuitive to what we hear. And I guess, like you say, it kind of depends regionally where you are. But that's really interesting. So there's a glut there was like an oversupply. Do you think it's I guess what maybe classical economists would call um, like traditionally like malinvestment? So there was too much stimulus and it signaled, to build, and now it's got to sort of pull back and correct.
Yeah, I think the malinvestment piece would actually be some of the investor speculation that was also pretty rampant in these
Right.
areas that kind of got turned on its head, especially when, you're in that inflationary environment. What happens first is you see these little boom in home values, and so people get really excited. What happens on the back end of that is not only does the demand pull back, but the carrying costs all go up, which was, in Florida, you see that incredibly with the insurance costs. Insurance has risen a lot in Texas as well. And then the property taxes are also kind of that lagging piece that sort of start to catch up with you. And suddenly, I don't think there's a lot of properties that are going to pencil out on paper for an investor to be buying at these interest rates and these prices when you're looking at these elevated insurance and elevated tax costs. So the investors have also pretty much fled for the woods, or, they're kind of laying low right now because they don't like the numbers in these markets either. Um, but there are still a few pockets of the country that have really tight inventory, places where we haven't built at all, places where there just isn't land to do new construction. And investor money still continues to consolidate in some of those areas, and that's areas where we're seeing prices are still holding up, even rising in some of those parts of the country, which is kind of why we're getting that data that the case Shiller and all of that data is lagged, like at least 3 to 6 months. So first of all, I don't think the current, we keep seeing every single month we see something come out like new record high in home prices nationally. Um, that is not up to date, right, to today. That is based off of like the numbers we're getting now are probably coming from like the spring peak sales. So I don't think that those are like fully accurate and up to date. But the reason why the number is strong at all is because of those strong regions of the country. They are sort of like pulling the weight and carrying these weakening regions of the country that like I just really think some of these weakening regions are a lot weaker than any data is capturing. And I can go into that more in a bit as to why. Um, but that is sort of, I think, why there's that disconnect between, oh my goodness, we keep showing these record high Case-Shiller numbers. Like, why did these rate hikes not work, sort of thing? The short answer is they did work. There was a lag before they impacted the market, A. B, there is a lag before the impact in the market then hits the data. And you guys will understand that because your inflation data, I think, is more to date than the BLS official CPI data that's coming through. And so you can see how if there's a lag, um, it's going to have a pretty big impact on people's sentiment and their mindset about how the economy is doing and how inflation is doing.
Yeah, as you were talking, I was kind of thinking like it's a for a visual would be like an economic slinky. You remember the slinky that used to go down the stairs? Sort of everything is catching up on the backside. Um, I noticed in your feed on X, um, obviously you're a mom and you think quite a bit about the future and the generation gap. Um, we've got a presidential election. I'm trying to shoehorn as many topics as I can in one question here. So we've got this obvious gap, and a lot of young people worried about the possibility of getting their first home. And then right during all of that are two candidates that are promising the world. I think the Harris campaign is looking at a $25,000. By the way, if I get it wrong, I don't intend to. I'm not intending to. Something like $25,000 credit towards first-time home buyers or maybe all home buyers. And I'm not exactly sure what the Trump plan is, but I know it involves some sort of tax regime or cuts or whatever. How do you see all that playing out for young people? Do they have um, a horse in that race, or is it dependent necessarily on who takes the White House, or is that irrelevant? Or you can choose from any one of the potpourri of nonsensical questions I just asked you.
I think the housing market is has got a lot of deeply embedded problems that are more as a result of Fed policy over the last 15, 20 years that is kind of not really partisan and is going to be difficult to resolve politically. I do believe, that said, I do believe that some of the proposed policies are going to be more inflationary than others. Obviously, if you hand out $25,000 down payments to everybody, that's going to be very stimulatory towards demand. And that's, come alongside also a promise of building, I think, 3 million homes. But I believe that the program of handing out the down payments was supposed to cover, the goal of the Harris campaign was to get, I think they said over the course of her term, 4 million first-time home buyers in homes. So they have a demand stimulus that's going to affect 4 million, ideally, as they want it done. And then they're going to have a supply stimulus. Their target was to build 3 million. And that's, if that's actually done and those are actually built, that's still going to give you a deficit of 1 million homes. So I don't see how those policies are going to fix the supply and demand problem long term, but I also don't see how really any candidate is going to be able to single-handedly fix the supply and demand problem in the short term. Certainly
Right.
not. So um, when it comes to the election, I think it's kind of a question of who's going to do the least damage. I don't think that anybody's going to be able to solve housing for young people, and I wish that that wasn't the case. But if you just look at everything that's going on, and I think if you step back even way bigger and zoom back at kind of what the Federal Reserve is kind of aiming to do and said that they're trying to do and what they kind of need to do with inflation, it doesn't leave a lot of room for housing to do anything except go up. And a lot of people are going to hate that answer, but if you look at just this recent 50 basis point rate cut, when we've got inflation still running, according to their numbers, 2.5%, and according to your numbers, it's slightly lower than that. But it's all just kind of, it's all kind of nuts to me, because you've got, you guys are a private company and you're coming up with this really solid, your entire career business is based on trying to get the most accurate, up to date measurement of inflation. And I assume the government, I'll give them good intent, I assume they're trying to do the same thing as well with their data and their, what they're doing and all of that. And you guys are coming up with numbers that are almost like at least, I think it's like 0.5 to 1%, depending on the time of year, variance. And you two are the best in the business coming up with this data. A 1 percentage point variance is a huge deal, because they will tweak monetary policy, of global monetary policy, based off of a 0.5% or 1% variance, because what they're trying to do is precise inflation targeting with imprecise data, and your data speaks to how imprecise the calculation process is. And I think the unfortunate end result of whenever you are going to be trying to do something like this, it's kind of a fool's errand, where what we've seen over the last specifically 4 years is that they're going to probably be erring on the side of too high rather than too low when it comes to that, inflation target, and whether or not they're going to be hitting that inflation target. And it's unfortunate. And again, I don't think they're being political in the sense that they're partisan. I think they're being political in the sense that they, as an institution, understand what this economy that runs on credit needs to do to survive, and what kind of a gridlock they're dealing with in Washington, with politicians who are not willing to raise the taxes that are needed to get our balance sheet looking good, not willing to cut entitlements that are needed to get, again, our debt problem under control. So yeah, fundamentally, I mean, it's very hard to make a long-term deflationary case for home prices when you're going into it with this sort of knowledge about how the Federal Reserve is viewing inflation.
Yeah. You're listening to Truflation Space's pre-BLS CPI edition. That's the great Amy Nixon, housing expert here in the U.S., kind of breaking everything down, trying to deal with my silly questions. Um, I think for younger people especially, the the real question for them is whether to continue renting or to try to muster up that down payment, with the hope that the Fed keeps cutting. It's an old debate. It's been around for a long, long time, but I kind of see it coming back up again. And by the way, those that are listening, if you have questions, go ahead and request, and I'll bring you right up for Amy Nixon. Um, do you where do you, I mean, obviously it's individual for different people, and maybe if it's regional in some cases, so I might have just answered my own question, but where do you come down generally right now in the current state of things on the rent to own idea? Do you have any strong opinions there, Amy?
Right now, it's significantly less of a monthly cost to rent in most markets. Um, so if you're going to get an equivalent property in a lot of regions, you're going to be paying like $1,000 a month less to just rent that property versus to buy that property with whatever the current mortgage rate and down payment and whatever is prices that are required. So today, if you're looking at those two numbers, you're going to be like, oh, it makes more sense to rent. But on a longer term basis, typically those spreads tend to narrow. There doesn't usually stay for, that wide of a gap between rent and own over long periods of time. So the way it's looking now, like I said, with like an inflationary pressure environment, the inflationary pressures are going to be on the rent component. And, my concern is that those rents are going to continue to push up and try to meet with those home prices, which in some regions might be coming down a little bit. But I actually I empathize with young people because I am actually like, my family's in this position. My husband and I are renting a home, and we are looking at in the Dallas market. And I actually think, I mean, my honest opinion is the next 6 to 12 months may be an opportunity for people to get in on whatever bit of disinflation and deflation that we have gotten out of these rate hikes, out of this hiking cycle. It is sort of coming to roost. Like, it's actually started coming to roost this summer. It's just that the data hasn't really officially picked up on it, because we've got, I can say in my own neighborhood, there's homes that have been sitting on the market since April, and it's October now. They haven't sold. They were listed at, $900,000. Now they're down to 750. Somebody's going to bid on that and buy it. And when that data comes through and it closes, that's when, 4 months later, Case Shiller's going to come in and say, oh, look, home prices did fall 5% or 10% in that neighborhood. But by the time you get that data from Case Shiller, the market might have already started to turn the other way.
Right.
And I already see this in your guys' inflation data, because you guys were coming in, I think, like close to like 1.5% a little while back, and now you guys are inching back up closer to 2.
Mm-hmm.
So I would tell people to like pay really close attention to the real time inflation data, because there's going to be a window where the numbers look better, and it looks like we're getting that longed for deflation and disinflation, and especially in these certain markets like the Sunbelt markets. But I'm not sure if it's going to flip and have a flippening at some point in 25 where it starts to tick back up. And so if you want to, you might be lucky and be able to sort of slide into that like sweet spot window in the next 6 to 12 months where you can get a property that's been like languishing on the market with a low ball offer. And again, I'm not just throwing this out there as like wild talk. My husband and I have actually looked at a house that's been for sale for 7 months in our neighborhood, and we're like, if we offered, X below list, like, would they take it? And it's annoying for us because we would have to break a lease in order to do it. So it would have to be like really a home we wanted, like for sure. And we'd have to really be convinced that the market won't be worse next spring, which we're not convinced how long this little mini downturn is going to last. But I do think there is going to be a weakening in many markets over the next like 6 to 9 months that could be an opportunity for people to step in. But I cannot say, here's where the bottom will be, and this is the time to buy versus not. But again, like if you had bought in 2009, then in 2010 you would have been sad, but in 2015 you wouldn't have cared. So you kind of have to look a really long-term perspective on housing, because you're supposed to own these things for like at least 7 to 10 years and raise a family in it, and it's not supposed to be like some stock that you check every day to see like, oh, what's my value today.
Right, right. It's a long term investment. You're listening to Truflation Spaces pre BLS CPI edition with the great Amy Nixon, and on in the on deck circle is the pretty wonderful Adam Taggart, who will be coming on in just a few minutes here. Amy, as we kind of wrap up a little bit, um, you're suggesting that it might be a good time in the next year or so to enter the housing market. I think it's a good place to kind of ask you, as an expert, what makes a good real estate agent? Like, what should, in general, someone look for? I have a feeling you have some strong opinions on that.
Yeah. I think the two biggest pieces are somebody who is totally honest, number one, just totally honest about what they know about the market, what they're seeing, with buyers and bidders and all of that. And somebody who knows the particular market you're looking in very well. You honestly, what my husband and I have always done is find somebody who lives in the neighborhood that we want to buy the house in, because that's going to be a person who's like an expert in that neighborhood. They're going to care about the sale because it's going to affect their own comp in their own neighborhood. Um, so, really, the most important things are somebody who really understands the local market as best as possible, and somebody who's going to be just completely honest with you. And there are agents who are honest, right now, that there's a lot of agents that are very well aware that the Dallas market, especially in the exurbs where I am, is weakening. And um, they'll tell you, they're not going to push you to put in a list price offer. They're going to say, hey, look, this house has been sitting on the market for 6 months. Why don't you come in low and see what you can get away with, I guess, in terms of pricing. And that's one of the things I like. A lot of people are going to be like, I can't believe this woman's telling me like this might be a good time to enter the housing market. But from a psychological standpoint, from compared to the last 3 to 4 years, the market we have now has shifted from, what we had 3 to 4 years ago, which was 30 people qualified to buy the same property, all asking themselves, what is the most I'm willing to pay to get this property? Because that's the psychological buyer mindset when you're in a bidding war. And that is completely flipped on its head now to a market where there's surplus inventory and not enough demand, to where buyers are asking themselves, what is the least amount of money that I can offer and still get this seller to sell me their home? And that's a much more buyer friendly market. Whether or not, you think it's still, gosh, these prices are really high and interest rates are still not high on a historical basis, but high on a relative to recent history basis. Um, and again, like what we're seeing since the Fed cut rates is the mortgage rates are not really coming down very much. A lot of the rate cuts happened over the summer, in terms of like not the Fed cutting rates, but the mortgage rates started to price all of the rate cuts in over the summer and come down. And so rates have actually risen a blip since the rate cut actually was put into place. And I just don't think, again, like I was talking to you earlier about my inflation expectations, I don't see rates going under 5. I don't think it's going to be possible unless the economy is like a total train wreck. And if that's the case, then we're going to have a lot of other problems than just people trying to buy a house. So my expectation is that rates are going to stay relatively high, and the market's going to continue to be a struggle for the next couple of years in terms of like sales volumes and inventory in those tight inventory regions. Kind of like what we went through in the 1970s, like just kind of a painful decade for housing. And we were a little bit saved in that era by the fact that women went back to work and we were able to sort of double household incomes. That's kind of what saved the market back then. And I don't know what's the saving grace going to be this time around. Maybe it's like somebody has 6 gig jobs. It's looking kind of bleak. It's looking kind of bleak on that front.
Yeah.
Um, but you know what I think honestly is the piece that's shifted. That's really hard for a lot of people to understand and really frustrating for young families too. Is that since 2010 we have new use cases for U.S. housing besides just raising a family. And as a result of that, there's been a lot of investor money and there's a lot of just wealth circulating in the economy that's buying houses. Homes are being bought in record numbers with cash because we have a wealth effect, stocks, et cetera, being poured into housing that is sort of bypassing that need for the median incomes to line up in any sort of rational way with the home prices. And we have homes now that are being used as motels, Airbnbs, all throughout the country. There's a chunk of housing stock that's now being priced as how much money can this earn me as a hotel or motel. And there's, something else I've seen recently too is something else that happened and changed in 2010 is social media. The emergence of social media has now made it so that I am seeing people rent houses out by the like 2 hour chunk, and they buy a big house with a pool. They're renting it to content creators, and for $200 an hour or whatever. If you get enough people to do this, it sounds funny, but if you get enough people to do that, you can pay a ridiculous mortgage payment, and it works as an investment property. So again, it's like really sad to see these places that were supposed to be neighborhood homes raising families being turned into these free market distortions have created these bizarre use cases for housing. But as long as they exist, the market will find a way to support that. As long as people are renting those, as long as people are taking trips and using the Airbnbs, we can't rule those factors out as real pieces that are impacting the market, even if we hate them.
Right, right. No, it's an excellent point, and it's one that almost every housing analyst that we've talked to fails to bring up. It's that sort of market that we don't pay enough attention to with the Airbnbs, and I didn't even think about the influencer side. I'm definitely going to start renting out my home for rap videos. Um, Okay, so moving along here, you are listening to Truflation Spaces. It's the pre-BLS CPI edition. We've got, I believe, a question or a comment for Amy from Bear. Julius, go ahead. Your question for Amy. You're up.
Well, I have a question for Amy. Why would she, let's say, remove deflation as a possibility while there is a lot of signals in the economy that there is deflation happening? The inflation already happened. The prices is at all-time high. People cannot afford to buy at those prices. Warren Buffett is sitting on record cash. Okay. If you buy now, pretty much you are renting because at 6.5%, 7%, 8%, you are paying interest. So for 7 years, 10 years, most people do not sit on their homes for 7 years. So why would she, let's say we might not have deflation? Like, why would you think that insiders are selling in stocks? So I would like to know her answer.
Yeah. Did you get that, Amy?
I did, and the answer that it's been a painful process for me to come up with this over time, but I do believe that it is correct, is looking at what the Federal Reserve has done with regards to the economy with inflation versus deflation over the last 2 decades. Not looking at what they say, but looking at what they do. And I circle back to 2020 when they first introduced this flexible average inflation targeting at their August 2020 FOMC meeting. They said, we're going to basically allow for a period of inflation that's going to run hotter than that 2% target that was introduced in 2012. So they, first of all, they introduced a 2% target in 2012. We didn't have an inflation target prior to that. They introduced it saying, we want inflation. We just want it to be this number of 2%. And it undershot that for most of the post-financial crisis. So we were running like 1.5%. So in 2020, they rolled out this flexible average inflation targeting saying, we're going to allow us to overshoot it for the next whatever period of time so that hopefully all averages out to 2 over time. And then what they did, that was in August of 2020. What did they do in 2021? We had inflation running 2, almost 3%. Or no, 3 times, sorry, not percent, 3 times their stated target. And they didn't change policy from the lowest rates in history. They came out and they said things like transitory and global supply chain shocks and blah, 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 blah. They didn't do anything to stop the inflation. And my question that I will always have is, was there a threshold number that we breached that triggered them to hike? Or did they simply hike because inflation started to become a political problem? And again, not because they're partisan, but because it was becoming a problem for American citizens. Was that the tipping point that made them hike? Because once again, now I'm seeing where the flip of that is 4 years later, we're in a position where the economy showed a little bit of weakness, over this past, I'd say like 6 to 12 months. There were probably would be considered rolling recessions in certain sectors. Yes, I agree that there's been weakness. Unemployment's been rising. We conveniently got this massive, 800,000 job revision a month before they wanted to drop a 50 basis point cut. What they basically did on the flip side was they cut rates as soon as there was a little bit of disinflation and deflation starting to trickle through the economy. So their response to inflation was to sit on their hands and say, oh, let's see how bad this gets. But the response to deflation was to drop a 50 basis point hammer as soon as it started to vaguely threaten what everybody in the media is saying is this really great economy. So I'm not convinced that going forward, what's going to happen in late 2025 if we start breaching up that upper level of inflation? Are we going to go to 3%? Is that going to start to trigger them to think about hiking again? Where's going to be that upper bounds breach point where they change policy again? That's it. Their actions to me signal that they want as much inflation as the American people will let them get away with. And I that sounds like they're these evil villains. They're not evil villains, but what they are is people who are trying to deal with an economy that has $35 trillion of debt, 36, I don't even know how high we're at, a lot of $1 trillion of debt. And they're doing so in a political environment that is so divisive that we have presidents who come to them and beg for rate cuts. The most powerful man in the world is coming to another man and asking him to do something for him. So really then it begs the question, who is the most powerful man in the world? Is it the person that we democratically elected? Or is it the person that was a former investment banker that was appointed by somebody? And we have our elected congressional officials, like Elizabeth Warren, for example, instead of doing the things we asked her to do, like pass laws, pass regulations, pass tax changes to regulate our economy, she's writing letters to this Federal Reserve saying we need a 75 basis point rate hike. The power structure is just so out of whack that my concern is that everything is being dumped on the Fed. We're putting everything on the Fed to fix our deficits, to run the economy. And unfortunately, because of the way our economy looks, long term, really the only card they have to play is to let inflation run a little bit hot. So we may have a brief period of deflation coming in the next 6 to 12 months. I don't think that's like completely out of the question. I do think there has been weakness in the economy over the last period of, at least since spring. And that may continue to play out in the data over the next year. We may see that disinflation and deflation actually continue. But I think they're going to react to it pretty strongly and try to push it in the other direction, because we really can't afford as a country to have another post 2008 decade that really set us back in terms of our debt and our problems within our own economy. And I hate this answer. I wish I had something better to say, because I really wish that this wasn't the reality that we're facing. But I don't see a way around that. I don't think the Fed really has another option that doesn't involve like completely like bombing like the entire economy and causing a complete like economic meltdown of everything. And I
Yeah.
just don't think that they're going to do that, because it's not politically viable to do that. So
Yeah.
I'm sorry, I don't
No,
like it, but
it's all your fault. Do us a favor and give Amy Nixon a follow. She's a great follow. Really interesting, insightful person, as you've heard. It's all of that's a pretty cool jumping off point to bring in Adam Taggart of Thoughtful Money. He's an educator, investor, entrepreneur, podcast host. Adam is sought out for his expertise on all things macro and actually micro. He's a bit of an evangelist. Adam, you've been so freaking patient, man. I really appreciate it. We have guest inflation today. Who would have thought? Truflation bringing guest inflation. Adam, thanks so much, man, for coming on. We really appreciate it.
Hey, it's a pleasure to be here.
So, listening to Amy kind of break it down for us, both in housing and inflation. Yeah, what's your 30,000 foot take on the American economy? Where do you see things now?
Okay. First, I want to say I agree pretty much with Amy's read of everything she talked about, especially on the housing market. I was trying to think of what's going to be my angle for this discussion, and I came down on this, which is, if you're not confused, you're not paying attention. And for your viewers who might not be familiar with me, my day job is talking to the top minds in money in the markets. So I don't really like to put myself out there as an economic guru, despite your very kind introduction. But if I'm an expert of anything, it's probably of other experts in what they're thinking. And at no time in my career of doing this have I seen the experts more all over the map the way that they are right now. Some people are quite bearish, understandably. There are some people that are very bullish right now. I just interviewed two bears in the past 24 hours, or people that I would consider as bearish in terms of their outlooks on the markets. But their macroeconomic outlooks couldn't be more different. So there's just sort of disagreements all around the map here. And really at the core of it is folks' inflation expectations, and thereby where they see interest rates headed from here. So we can delve into anything you want to talk about here, but let me just give you the progression that I think is really important for each of the listeners here. If they're trying to come up with an outlook that they are going to take action on in their own investing, you have to really try to get a beat on where you think inflation's headed, what impacts that's going to have for interest rates, what's that going to mean for corporate profits going forward, how is that going to impact the employment situation, and then what impact is it going to have on consumer spending? Because as a reminder to everybody here, our economy is still about a 70% consumer spending GDP. And so those are the breadcrumbs you need to follow to then determine what you think is going to happen. I would say, based on the people that I listen to and talk with every week, for the past 2 years, it has felt like we were just waiting for the shoes to drop from the lag effects of all of the hiking that the Fed and the other major central banks had done. And I think we've seen some manifestation of some of those lag effects in certain parts of the economy, but not nearly to the extent that people were expecting. And I think that's been a real head scratcher, which was that going into 2023, everybody expected 2023 to be the year of the recession, and it wasn't. Coming into 2024, I think expectations were 2024 was going to be the year of the hard landing. Well, that didn't happen either. So now we're looking to turn the corner here into 2025, and there's still a lot of opportunity here to make a bullish case if you want to. So one of the first questions you got to ask yourself is, well, geez, why? Why were so many people so wrong? How were we able to raise the cost of capital across the world as aggressively as we did, and not suffer any serious macroeconomic consequences of that? And I think the answer, if I can put it in just the most basic terms, has been liquidity. Global liquidity flows were shrinking throughout 2022. And that's, in many reasons, looking back, why 2022 was such a bad year in almost every asset class. Those global liquidity flows bottomed in October of 2022, which, no big surprise, was when the financial markets bottomed as well. And it's largely been powering higher ever since. And it still continues to. I think one thing that's really important, we cannot ignore, is that in just the past couple months, we went from a kind of global tightening regime to now where the world's largest economies are back into easing mode. The Fed has pivoted officially. It's now cutting interest rates. The ECB actually started cutting rates before the Fed did. And China has just, over the past couple of weeks, fired up their monetary bazooka as well as their fiscal bazooka. And speaking of fiscal bazookas, we sort of never stop firing ours. We are deficit spending on the fiscal side at unprecedented absolute levels and rare relative levels in terms of a percent of GDP. We've never spent this much of a percent of our GDP in deficit outside of a major world war. So to that fellow who asked Amy the question about, hey, how can you discount deflation? I can come up with a very long list of deflationary risks that should and you could and probably should be happening on the economy, but they have to fight their way through that rising tide of global liquidity.
Yeah, when you were saying it, a couple things. One is the confusion, that aspect that you've hit on, I think is spot on. The numbers are just ridiculous. I can't wrap my head around them. And we're at Truflation, we're still, I think everybody who reads Truflation daily looks at it and looks at that number and is trying to figure out what it means, because we've literally never had real-time inflation numbers flashing before us. And so what do we do? So everybody thinks they know, where the tea leaves and kind of where things are pointing, but it's like you say, it's such a Rorschach test. People look at it and they say, oh, this means this and this means that. So that was an excellent point, I thought. And the other is on the liquidity side. Liquidity is one of those words that can mean different things to different people. I heard Peter Thiel say something along the lines of, we've been in a recession for a year. It's just we papered over it, and that's very attractive to me. Being cynical, I mean, is he right, or do you think we're fundamentally sound?
I do not think we're fundamentally sound, Amy was sort of talking about how her brain kind of recoils a bit by telling people it actually might not be a bad time to buy a house, when she's been covering the housing market for such a long time and pointing out how we're at record levels of unaffordability and, all the issues that make you think the housing market's richly priced. I think people have a similar recoiling of, are we going to be able to kind of get through all this that we've been through with a no landing scenario where we didn't really have to pay the price of a lot of extreme measures that we took. And I don't know the answer to that question yet. I personally think that there is a piper that will have to be paid, but um, similar to Peter Thiel, folks like Ed Yardeni have said, we've kind of been in this rolling recession where the economy as a whole didn't go into recession at the same time. It was different industries entering it and then exiting it at different times. So it's almost like a baton that's getting passed along. And on a net average, the economy was still able to kind of just, muddle through and chug along. And, no matter how pessimistic you might be on the economy, to the extent that we can believe the data that we're given, it's the only data we're given, GDP has done all right. We've had a pretty decent year GDP wise so far in 2024. In fact, GDP now is still clocking us in at 3.2% right now, I think is the latest estimate for the current quarter. It seems like the game that's being played by the central planners is, can we paper over enough of the injuries that they have enough time to heal, that if there's a point at which these liquidity waters start to recede, we've largely healed from the major damage and the economy comes out of this on the other side. If they do, to be honest, to a certain extent, the central planners probably deserve a lot of praise for that in terms of just not cratering the economy. Now, that being said, I mentioned at the beginning here that what really matters at the end of the day is that progression I talked about, which ended at consumer spending, because that's really the driver of the economy here. Whether or not the BLS says we're in recession or Peter Thiel says we're in recession, what matters more is what consumers think and what they do. And there was a recent survey that came out by a firm that said 3 out of 5 U.S. adults report that they are in a recession, that they are personally living in a recession. And to the extent that that continues, that influences their spending, right? Either their ability to spend, they just literally can't spend beyond a certain amount, or they get more nervous about their future prospects and then constrain their spending. And in both cases, that then reduces the amount of purchasing done in the economy, and then that flows through to corporate profits, and then this corporate profit gets squeezed. Those companies have to then cut costs, and they might cut costs by laying more people off, ergo making more people stressed about their financial prospects, and you begin to get into that vicious cycle. That hasn't quite happened yet, but I do think we are seeing some real potential signs, danger signs of that. And so we may end up getting some of these economic repercussions that we haven't received yet, without the economy necessarily falling into some sort of massive crisis. It just literally could be a progression of consumers increasingly tightening their belts. I think one of the key things to be looking at here is the employment market, and that has been a really I'm going to go back to kind of the theme of the head scratcher, right? So over the past year plus, the employment market has looked unbelievably rosy, and I certainly have spent a lot of time talking with the experts on my channel about the suspect nature of a lot of that jobs data, and that's been validated. I think Amy mentioned the over 800,000 reduction made in payrolls a few weeks back. So we are kind of seeing that either they've been intentionally putting lipstick on a pig. It's an election year after all. Or as Neely Taminga has said, and I see she's one of the listeners today, is that the deformations to the unemployment data during COVID of just laying off tens of millions of people and then scrambling to rehire them created such a bullwhip effect, such massive distortions in the BLS models that those effects are still rippling, several years later, and just making their models a lot less predictive than they normally are. So anyways, we sort of had this imperfect data that have suggested that things were fine, and that has been data that has been influencing the Fed's policies, right? So there's a worry here that we have a pilot flying our economic ship of state who's navigating by faulty instrumentation here, right? So one of the things, if we look outside the window of the plane, if we will, versus just at the instrumentation, we do see some real signs of stress. Like we saw a lot of, the precursors that you would expect to see to layoffs, like hiring freezes in place. Even though there's been a lot more job openings than applicants, we've been told. The vast amount of anecdotal on the ground is that these are all basically phantom job openings. They're largely for optics at these companies, and they're not really getting hired. And anybody here, I'm sure Neely would corroborate this. Anybody here that talks to young adults, people that are leaving college and trying to actually get into the workforce, are finding it incredibly frustrating. We are also at the point too where we are seeing layoffs really begin to pick up speed. And I just want to quote one statistic here. In August, layoffs soared, hitting their highest total in 15 years, while at the same time, year-to-date hiring hit the lowest in 19 years. And this is coming from a Challenger Gray survey. So, we're seeing a lot of real-world evidence out there that the jobs market isn't nearly as healthy as we've been told. And interestingly, this is kind of by design, right? When the Fed started its hiking cycle, it very clearly said, look, the jobs market is kind of too hot, and that's leading to wage inflation, and we got to start getting that down. So in many ways, this is just the natural outcome of policy to date. Now, the big question is, is the Fed able to finesse this sort of surgical, soft landing when it has imperfect information and, as Amy said earlier, very crude tools? I will note that if you look at the pattern of the unemployment rate for the past 50 years, it is very, very consistent, which is once you come out of a recession, the economy starts healing, people start hiring back, the unemployment rate declines. It then gets very quiescent, it bottoms, and then as soon as it starts picking up, almost in every case in the data series, it spikes. It's something that is fine until very suddenly it's not, and then those spikes, retroactively are all basically kind of mark the entry into the next recession. And if you look at the current unemployment rate, it is very much seeming to be following that trajectory where it's been trending down, since the COVID days. Got very quiet, formed a very clear bottom, has started to come up. It has ticked down in the most recent month, but not by a ton. I don't think it's enough to change the trend yet. You have to ask yourself at this point, is the preponderance of history going to repeat here? Or is something truly different this time about the economy, about the employment market? I don't think it is. And in fact, I'll even add one new thing that's different this time that we haven't had before, which is the advanced state of productivity technology here. So obviously that's automation and software, and of course the growing impact of AI. And one of the things that we've done by hiking interest rates and making human capital more expensive to employ is we have, this is not a new issue, but it's one that we've exacerbated over recent years. We gave a real strong incentive to corporations to try to replace as much human capital as possible. And what we're finding right now is that productivity has actually started really increasing again in corporate America. But even in the most recent jobs report that we just got, which was quote unquote a good jobs report, once you dig into the data there, what we're finding is that one, corporate America is not hiring people. Almost all the hiring has come from the government. And certainly, not for corporate America, it's not full-time jobs. It's just part-time jobs. That's where all the increases have come from. And so, what we're finding is that especially as AI continues to infiltrate corporate America, is that corporations. Oh, sorry. The key thing I forgot to mention is in that jobs report is hours worked declined. So people were cheering that the average hourly wage actually ticked up a little bit. But it wasn't because wages paid per hour increased. It was that wages remained the same, but hours worked went down. And therefore, corporations are basically sending a signal that they need fewer people right now. So that may be because we're entering a down cycle in demand by employers for employees. And if we are, the question is that something that's just cyclical and we'll ride out of it? Or are we seeing something that's more of a more permanent replacement of human capital with automation here? And I have a really hard time, especially when I talk to experts in AI about, what they think its capabilities are. I have a really hard time not seeing AI as a long-term job killer here. And I think we're already beginning to see that in several industries.
Yeah, you're listening to Truflation Spaces pre-BLS CPI edition. We're ahead of the print tomorrow from officialdom, from government. As you were talking, I was thinking of Senator Kennedy when he was speaking to Jay Powell a few months back, and he just asked him point blank, once you do what you're going to do, the sacrifice is jobs. And you could see Powell, who's, he's got a pretty good poker face. You could see him swallow hard on that. We've got a question here from Strandberg. Strandberg, you're up. You got to go ahead and ask.
Hello, hi everyone. My question is for Amy. I'm curious about your thesis regarding the impacts of Fed funds rate cuts on mortgage rates. Given your previous answer that implies that a lower level of Fed funds rates would have a negative impact on the mortgage rates. Could you please explain how you think a lower Fed funds rate will lead to lower mortgage rates? And a little premise ask this question because mortgage rates are historically correlated to the 10-year treasury rates more than they are to the Fed funds rate. And therefore, could you please go a little bit more in depth into why into the reasons for your thesis, let's say? Thank you.
It just hit 4, just touched above 4, right? I'm sorry, Amy, did you hear that?
Yes, I'm trying to fully understand the question. Is he asking what's my projection for mortgage rates, or?
No, I'm asking about. Sorry if my question was a little unclear. Mechanically, what is the underlying reason that would cause a lower mortgage rates level in percent terms? What is the reason that would make the cause for a let's say that would what is the reason that would cause the mortgage rates to lower the average level of 30-year mortgage rates, let's say, upon a rate cut in terms of effective funds rate?
The mortgage rates are kind of they're running off of the 10-year now, and unfortunately, the 10-year is kind of calling the Fed out a little bit with how it's responded to the first cut. So right now the 10-year is going up, but the rate was just cut, and there's more rate expectations on the table. I think we would need to see a substantial amount of cuts alongside a clear expectation from the bond market that inflation is no longer a threat in order for us to get mortgage rates to go back down to something like under 5. I don't really see, with what the Fed has come out and said about they want to have a higher base Fed funds rate going forward, they are saying they don't want to go back to kind of like that zero interest rate policy that we had in the 2010s decade. So the only scenario that I can see where we would get aggressive rate cuts beyond what they penciled in that the market would interpret as sort of like an the bearish scenario is correct and the economy is in worse condition than we thought, and there's actually deflation is the bigger threat. Those are the instances where you see the mortgage rates drop, as the rates are cut. I mean, they're going to come down as the rates are cut. They are going to trend down overall. Over time, there's going to be little blips, as like this week when the 10-year responded, to the inflation expectations, because the 10-year was responding to recent inflationary data that we just got. I think right now is a unique period in history where there's more volatility there in the bond market than we're historically used to. I think just because we're in that inflationary era and the market's kind of getting spooked very easily by stuff. But I do expect mortgage rates will be trending down over the next 6 months. They're gonna head down, but in order to go really low, like below 5%, I think we're gonna have to have a significant series of cuts that the bond market isn't fighting against because it sees them as risks for inflation. If that makes any sense.
Yeah, fascinating. You've been listening to.
Can I build on that just
Yeah,
for a second?
go, please. I was just about to ask you, actually.
I will, but here, look, I'll let you give your plug for Truflation first, just so folks know what we're listening to.
You're listening to Truflation Spaces, and I'll be putting out my address for rap influencer videos in just a minute. Go ahead, Adam.
Okay, great. Yeah, by the way, I'm interested in running your place for at least an hour. So if you're interested in learning more about this topic or exploring this topic further, I just did an interview yesterday with highly respected bond investor and short seller, Bill Fleckenstein. And I've interviewed Bill for many years, and he has talked about his expectation that at some point along this process, the bond market is going to start to lose faith, lose confidence in the Fed. And in Bill's word, it's going to start taking away the printing press from the Fed. That it's going to start constraining the Fed's ability to cut as much as it wants or to return to QE. And Bill is looking at what's happening right now in the bond market and has basically said, I don't know, this actually might be the moment that I've been waiting a long, long time for, where the Fed starts cutting and the bond market takes longer term yields in a different direction. He's not willing to say, hey, officially it's game on here, but he's saying I'm seeing all the precursors to that and the initial action that I would expect if we were heading down that route. So it's a fascinating discussion because obviously if we are at the point here where the Fed's tools that it's used to using and the world is used to it using and working a certain way all of a sudden no longer do, that has vast implications. I mean, if the cost of capital starts going up, no matter what the Fed is doing with the short end of the curve, that is going to be hugely constraining on economic growth. It's going to have huge implications for the housing market. So if that's something you want to learn more about, I highly recommend you watch that video with Bill.
Yeah, please do get out and make sure you subscribe to Thoughtful Money. It is mandatory listening, and it's something that we do at Truflation all the time. I have imposed upon both of our guests quite a bit of time, and we're already over here. So I want to make sure you do follow Amy Nixon here on X. Great follow, lots of insight, really, really interesting and sober analysis. And Adam, of course, where can people follow your work? I saw that you have a Substack too, right?
I do. I'll make it easy for folks. Just go to thoughtfulmoney.com. All the things we offer are there at that website. Our interviews, our newsletter, the Substack, our socials. And the key thing that I try to do, the mission of my company, is to try to help make people better informed so they can make more informed decisions with how to build their wealth. And then when possible, connect them with resources that might be useful to them in their journey. And one big question that I get a lot is hey, I've listened to your experts. I've got some really good ideas of what I want to do. I just don't feel comfortable doing it myself. Can you connect me with a professional that can help me do it? We have professional financial advisors who take into account all the macro issues that my speakers talk about, that we've talked about here today in this space. And so if you'd like to talk to one of those people for free, no commitment, no strings attached, you can do that through the website.
Yeah, because you're getting all this macro alpha, and it's food for thought. But then, as you started off in our segment here, even experts are confused, and they're like the Spider-Man meme. They're all pointing at each other and contradicting one another. So how do you move? What do you do? So get out to thoughtfulmoney.com and do that. Thanks again, Adam. Thank you, Amy. You're more than welcome to stick around. We're going to pivot to our head of data here at Truflation, Yvonne Yellick, who traditionally goes to start off the show. But again, we had guest inflation, and I wanted to get to them right away. And then my big mouth, I keep asking and taking up all the oxygen on the on the space with my questions. But Yvonne, can you? Because I realize you're also very busy. Appreciate you coming back on. Um, can you kind of give us back of the envelope inflation report? Kind of cliff notes. A nice little version here, so people can get out and read it for themselves later. But again, thanks for coming on, man.
Yeah, definitely. Great to be here again. And thanks to Adam and Amy for great insights, and especially wanna make a note and a suggestion to rename these spaces to "If you're not confused, you're not paying attention." Loved that note. So it shows you what actually we at Truflation are also seeing, and currently we can see, and I'll try to keep it as short as possible because I know we are over a few minutes already. So we also see signs, and it's similar to what we saw last month of economic resilience. But on the other hand, we are seeing the inflation returning. And for the tomorrow's reading of the CPI, the market forecasts are between 2.2% and 2.4%, where we at Truflation see that number landing at the top of the range at 2.4%. And the reason behind that is, and as we see it, is in the labor market, where, as I believe Adam mentioned, that BLS numbers are overly positive, and we know that they revised the numbers, and it shows additionally that a lot of those are coming from the government institutions. But on the other hand, what we noticed, and this is the confusing part, is that historically, in order to, or before the recession, you would have, and we were actually looking at initial claims. So you would have approximately 250,000 initial claims needed on average to get into the recessions that we've seen in history. And currently, we are nowhere near those levels. The reason behind that might be in some of the different requirements or criteria, how the initial claim is defined, what are the rules on how long you can stay, and so on. But from what we see, we're nowhere near there. And then the second aspect of the labor market is the wage pressure. So not sure who mentioned it from Adam and Amy, but we also we've seen in the last few weeks a lot of noise coming from the port workers, where they managed to negotiate a 68% increase of wages across 10-year period. But also, what is really important is to notice and note that there is a clause of non-automation, which basically limits the amount of automation that can be introduced into the already ports that are one of the lowest automated ones in the world. So this is where we see a potential inflation coming back from the services sector, which accounts for approximately 40% of the inflation number itself. So this is where we see the most of it coming. And also one fun fact that we had on Truflation Twitter poll, which is not a scientific report, but on the other hand, still shows a 30% of the voters saying that they will buy a new home and car when interest rates goes down. And I think Amy touched upon that topic a little bit. And what we see currently from the Fed watch is in next FOMC meeting that almost 85% of them predict another rate cut, and then that by the end of January we'll have a cut for up until that point another additional 50 basis points, which is coming to the levels between 400 to 425. So currently, numbers from the Fed Watch are saying that we'll see some of the rate cuts in the 2 to 3 upcoming meetings, but again, those are only forecasts, so we'll see how it goes. So as mentioned, we have a lot of pressures on the inflation, labor market. We also see a lot of geopolitical concerns that are coming up globally, supply chain with those port strikes, that's not definitely helping. So a lot of things that we see might cause the inflation go up.
Nice, very nice. Yeah, I forgot all about the port strike and hurricanes and wars, and I guess that's the point where I say, "Oh my." We do appreciate you hanging in there with us. It has been fantastic. Two incredible guests. Very, very big thank yous to Amy Nixon and Adam Taggart. Do support them. Get out and follow Amy here on X, and make sure you get out to thoughtfulmoney.com. We're back again. I think in November for the FOMC, and shortly before that for the next CPI edition. In the meantime, keep it tuned to here, Truflation at Truflation on X. Thanks again, everybody.